If I throw the ticker symbol O, just the letter O at you,
Yeah.
what is the immediate association? Because for 90% of the finance world, it's usually just one word: boring.
Dependable,
Right.
safe. The monthly dividend company, it is the quintessential widow and orphan stock.
Right. You picture this sleepy landlord collecting rent checks from 7-Eleven and Walgreens, passing that cash right back to you every single month, like clockwork. It's the stock you buy for your grandmother because you just don't want her calling you when the market crashes.
And historically, I mean, that has been the reputation. It's a bond proxy. You buy it for the yield. You don't really buy it for the excitement.
We'll grab a coffee because we are about to completely dismantle that reputation. We are looking at the Q4 and full year 2025 earnings report for Realty Income. This was released just yesterday, February 24, 2026. And honestly, this doesn't look like your grandmother's REIT anymore.
I would agree with that. If you really dig into the footnotes of this report, you see a company that is fundamentally mutating. They aren't just a landlord anymore. They are evolving into this massive, highly diversified financial platform.
Right. I mean, we're talking artificial intelligence predicting corporate bankruptcies before they hit the news. We're talking about billion-dollar deals with sovereign wealth funds. Entering Mexico, it feels like they are trying to be a tech company, a bank, and a developer all at once.
It is a lot of moving parts. But the mission for this deep dive isn't just to list out what they are doing. We need to figure out why. Why does a company this big, and we're talking over 15,500 properties, why do they need to change their DNA?
Yeah, how do they engineer growth when interest rates are still, a major hurdle for the entire real estate sector?
Exactly.
So let's start with the report card. The raw numbers for Q4 2025. Did they actually deliver, or is this all just corporate storytelling?
The numbers are solid, but you have to look past the top headline. Adjusted funds from operations, or AFFO, which is really the only metric that matters for dividend safety, came in at $1.08 per share for the quarter.
So that met the consensus estimate.
It met consensus, and the full year was $4.28.
And what about revenue?
Revenue was actually a beat. They brought in $1.49 billion for the quarter, beating expectations by nearly $93 million. That's an 11% jump year over year.
Okay, an 11% revenue jump for a company of this sheer size is significant. But I want to play devil's advocate here for a second. Revenue is great, but occupancy is where the rubber meets the road. Are the tenants actually staying put?
Occupancy is at 98.9%. That is statistically full. But the number that actually tells the real story of their leverage in this market is the rent recapture rate.
The recapture rate. Walk us through how that works.
Sure, so it's what happens when a lease expires. The tenant either leaves or they renew. In a high inflation, high cost environment, you might expect a landlord to lose pricing power. They might have to offer discounts to keep the lights on and keep the tenant in the building.
But Realty Income's recapture rate was over 103%.
Right.
So when a lease rolled over, they were re-renting the space for more money, not less.
Correct. It proves the underlying portfolio is very healthy. However, the real story of Q4 isn't the leases they kept, it is the leases they got rid of.
This is the at-home story. I was so fascinated by this part of the report.
Yes. This is the clearest evidence I've seen that they are shifting from passive rent collectors to active, data-driven traders.
So for context for you listening, At Home is a big box home decor retailer. They massive, cavernous warehouses full of pillows and patio furniture. They recently filed for Chapter 11 bankruptcy. Usually for a landlord, that is a total catastrophe. You're stuck with these empty 100,000 square foot boxes, zero rent coming in, and legal fees just piling up.
Typically, yes. That drags down earnings for at least a year. But Realty Income didn't wait for the filing.
Right. CEO Sumit Roy talked about this on the earnings call.
Yeah.
They didn't just guess that At Home was in trouble. They used a proprietary predictive analytics platform. They were watching store-level performance data way before the headlines ever hit the financial news.
They could see the foot traffic dropping. They could see the credit metrics deteriorating at the individual store level. This wasn't public information yet. This was their own internal data advantage.
So what did they do? Did they call the tenant and ask nicely for the rent to be paid early?
No, they went straight to the market. Over the 18 months before the bankruptcy filing, Realty Income quietly sold 8 at-home properties. They offloaded them to other investors for nearly $80 million.
Wait, isn't that... I mean, if they knew the tenant was failing, who on earth bought them?
Well, that's the nature of the real estate market. There are always buyers with different risk tolerances or different views on the underlying real estate's value. Maybe a buyer wants to redevelop the site. Realty Income sold the assets while they still had perceived value.
So by the time At Home actually filed for Chapter 11, Realty Income had significantly reduced their exposure.
Exactly. And for the stores they were stuck with, they achieved an 80% recapture rate on the remaining locations. They practically minimized the blast radius of a major corporate bankruptcy.
See, that's the mutant part I mentioned in the intro. That is not being a sleepy landlord. That is being a data-driven trader.
Yeah.
You're using information asymmetry to dump risk before it explodes in your face.
It creates this massive protective layer around the dividend. But if At Home was about defense, we really need to talk about their offense. Because the biggest problem for REITs right now isn't bad tenants, it is the cost of money.
Let's unpack this because it's structural. The traditional REIT model is pretty simple. You issue stock, you borrow some money, you buy a building, and you pocket the difference between the rent you collect and the interest you pay.
Spread model. Right. But that model is broken, or at least severely damaged in the current interest rate environment.
Because borrowing costs are just too high.
Exactly. And more importantly, reliance on the stock market is a massive weakness. If your stock price drops, your currency to buy new things becomes way too expensive. You get paralyzed. You literally can't grow because the math just doesn't work anymore.
So Realty Income decided to stop relying solely on the public stock market. They went out and engineered their own capital.
They did. And this is where the financial platform concept really takes shape. They launched a U.S. open-end Core Plus fund.
Okay, let's strip away the Wall Street jargon. What exactly is a Core Plus fund?
It is a private investment vehicle. Instead of buying Realty Income stock on the New York Stock Exchange, institutional investors think massive pension funds, endowments, sovereign wealth foundations. They can invest directly into this specific fund that is managed by Realty Income.
So they're entirely bypassing the public market. They raised, was it $1.5 billion?
$1.5 billion in committed capital. But you really have to understand why this changes the math for them. Sumit Roy calls it the flywheel. And honestly, for once, that corporate buzzword is actually accurate.
How does this flywheel change the return on, say, a random building?
Okay, imagine Realty Income wants to buy a grocery store that yields 6%. In the old days, if their cost of capital was 5.5%, they only make a tiny spread. It is barely worth doing all the paperwork.
Right. It's a lot of work and risk for a 0.5% profit margin.
But with the private fund, they are using other people's money. Realty Income acts as the asset manager. They might put in 20% of the equity themselves, and the pension funds put in the other 80%. But Realty Income charges management fees on the entire pot of money.
Ah, so they are getting paid just to run the show.
Correct. When you add those management fees to the return on their specific slice of equity, that boring 6% yield on the building transforms. On a simulated basis, their return on equity jumps to around 8.5%.
That is a massive difference. That is practically alchemy. They take a safe, boring 6% asset and turn it into a high-growth 8.5% return just by structuring the money differently.
It allows them to hunt in a much bigger pond. They don't need to go out and find risky, high-yield properties to make the math work. They can buy safe, boring assets and let the fee structure generate the alpha.
But doesn't this introduce a ton of complexity? I mean, now they have to answer to these massive private investors, not just us everyday public shareholders.
It absolutely does. It complicates the organizational chart. But it solves the existential crisis of being a REIT in a high-rate world. It decouples their ability to grow from the daily volatile fluctuations of their stock price.
Speaking of high rates, they pulled another lever in Q4 involving convertible notes. Now, I have to admit, my eyes usually glaze over when we start talking about convertible debt. But you flagged this in the notes as a major win.
It is a major win because of the arbitrage involved. In January 2026, they issued over $860 million in convertible notes.
And a convertible note is basically a loan that the lender can swap for stock later on if the price goes up, right?
Simplistically, yes. Investors accept a lower interest rate today for the potential upside of the stock tomorrow. Realty Income issued this massive chunk of debt at 3.5%.
3.5%. You can't get a standard residential mortgage for anywhere near that right now. That is incredibly cheap money.
It really is. Their standard 10-year bonds would cost them about 5% or more in this current market. So they took this $860 million at 3.5% and immediately used it to pay off older debt that was costing them over 5%.
So it's essentially like refinancing your high-interest credit card with a super low-interest personal loan.
It is pure arbitrage. While all of their competitors are drowning in rising interest expenses, Realty Income is actually lowering their cost of capital. CFO Jonathan Pong made a huge point of this on the call. This isn't just accounting tricks. This is pure cash savings that flows straight to the bottom line.
Okay, so they have the predictive data to dodge bankruptcies. They have the financial engineering to lower their costs and boost yields. But you can't just save your way to growth. You eventually have to buy things. And this is where I get a little skeptical about their strategy.
You're referring to the geographic expansion plans.
I'm referring to Mexico. This report confirmed Realty Income is officially entering Mexico. For 56 years, they have been laser-focused on the U.S. Recently, they dipped a toe into Europe. Now, they are heading south of the border.
It is a major pivot for them.
It feels risky to me. I mean, we all read the macro headlines. Cartel violence, political instability, crazy currency fluctuations. Why would a famously safe dividend company expose itself to that level of macro risk?
That is the natural knee-jerk reaction, but you have to look past the headlines and look at the macro trend driving this, which is nearshoring.
Meaning manufacturing moving closer to the U.S. consumer base.
Exactly. Major companies are pulling their supply chains out of China and moving them to Mexico to be closer to the U.S. It is a massive industrial boom. Realty Income wants to own the factories and the distribution warehouses that are powering that exact boom.
Okay, the broader thesis definitely makes sense. But what about the mechanics? If the Mexican peso crashes tomorrow, does my monthly dividend get cut?
No. And this is the most critical detail of the entire strategy. They aren't doing this alone. They are partnering with GIC, which is Singapore's massive sovereign wealth fund, and Hines. They are focusing strictly on industrial properties in major hubs like Mexico City and Guadalajara, but the most important part is the leases. They are denominated entirely in U.S. dollars.
Oh, wow. So the tenant pays in dollars regardless of what the peso is doing on any given Tuesday.
Correct. And they are targeting global investment-grade tenants. So you are essentially getting a U.S. corporate guarantee paid in U.S. dollars, but the physical building just happens to be sitting on Mexican soil.
So they're essentially importing U.S. stability into a high-growth emerging market.
That is the exact strategy. It completely mitigates the currency risk while tapping into an industrial market that is growing much, much faster than the U.S. domestic market right now.
The GIC partnership you mentioned that is not small potatoes either.
Not at all. They formed a programmatic joint venture to develop $1.5 billion in industrial properties. GIC is literally one of the biggest pools of capital on the planet.
When you say programmatic, does that mean they have some kind of template?
Right. It means they don't have to sit down and negotiate every single deal from scratch with an army of lawyers. They have a predefined box. If a new warehouse deal fits in the box, GIC just writes the check. It gives Realty Income a basically bottomless pocket of cash to execute large-scale developments without stressing their own corporate balance sheet.
It really seems like they're pivoting to become the go-to solution provider for the global giants.
Yeah.
I mean, they did something very similar with Blackstone in Las Vegas, right?
Yes, the $800 million investment in the Bellagio and CityCenter assets. But again, you have to look at the financial structure. It is a preferred equity deal.
Okay, for the listener who isn't a Wall Street investment banker, break down preferred equity for us.
Think of it like a buffet line at a restaurant. When a property makes money, there is a very specific order of who gets to eat first. The senior debt holders, the big banks, they always eat first. Then the preferred equity holders get their plate. The common equity holders, the people who own the regular stock, they eat last. They only get what is left over.
So by buying preferred equity in this massive casino asset,
Realty Income is cutting the line. They get paid their guaranteed return before Blackstone's common equity sees a single dime. It offers incredibly significant downside protection. If the casino has a bad year and revenues dip, Realty Income still gets its full check. Blackstone takes the hit.
and I imagine it deepens the relationship with Blackstone, which is the largest real estate manager in the world.
Precisely. Sumit Roy explicitly mentioned on the call that 89% of their Q4 transactions were relationship-driven. They are not scrolling through commercial Zillow looking for deals. They are getting the very first call from the biggest players in the global economy before these assets ever hit the open market.
I want to circle back to something we touched on way at the beginning, the tech side of things. Because hearing a commercial landlord talk about data lakes and machine learning usually sets off my corporate buzzword alarm.
I completely get that. Usually when a cement company or a landlord talks about AI, it's just a PR stunt to pump the stock price.
Right. So is this real or is it just fluff for the analysts.
In this specific case, the sheer scale makes it real. Realty Income owns 15,500 properties. You physically cannot manage that many locations with Excel spreadsheets and phone calls. It is impossible.
You would need an absolute army of analysts just reading leases all day.
Exactly. And Sumit Roy gave a really specific, tangible example about lease abstraction.
Which is basically the process of reading the physical contracts to pull out the key dates, things like rent bumps, expiration dates, renewal options.
Yes. Imagine doing that for 15,000 dense legal contracts manually. It is slow, it is incredibly boring, and humans inevitably make mistakes. Realty Income has actually been using machine learning for this process since 2019. Sumit noted that the success rate of their AI tool went from 80% to 90% in just a 4-month span recently.
So the machine is actually learning and getting faster.
It is. And they are organizing all this extracted data into these massive data lakes. This creates a legitimate information moat. If management wants to know, say, what is our total exposure to car washes in Florida if a Category 5 hurricane hits tomorrow, they can get that exact answer in seconds.
Whereas a smaller traditional competitor would have a team of paralegals digging through physical file cabinets for a week.
Exactly. And this tech infrastructure is what allows them to scale. They are currently guiding to invest roughly $8 billion in 2026. You cannot deploy $8 billion efficiently finding, vetting, modeling, and closing that many deals without a massive technological advantage.
Let's actually talk about that $8 billion number. That is their investment guidance for 2026. It feels very aggressive.
It is a huge jump. They did about $6.3 billion in total volume in 2025, so stepping up to $8 billion definitely shows a lot of confidence in their pipeline.
And what about the earnings per share guidance?
They are guiding for an AFFO of $4.38 to $4.42 per share. That represents a real acceleration in growth compared to the pace we saw in 2025.
But knowing how this management team operates, are they sandbagging? Are they purposefully setting the bar low right now so they can easily jump over it later in the year?
There is absolutely a layer of conservatism built into these numbers. Jonathan Pong, the CFO, mentioned they baked in a credit loss buffer of 40 to 50 basis points.
Translate that into dollars for us.
They are basically assuming that about 0.5% of their total expected revenue simply disappears because tenants go bankrupt or stop paying rent.
But is that based on specific tenants they know are currently in trouble? Like another at-home situation brewing?
That is the most interesting twist. They explicitly said a significant portion of that buffer is for unidentified risks. They don't know who is going to fail, and they don't know if anyone will actually fail, but they are conservatively assuming things will go wrong somewhere in the portfolio.
Or see if things don't go wrong.
That money flows straight through to the bottom line. It creates a massive amount of potential upside to that guidance. Sumit Roy explicitly called 2026 a potential banner year. He firmly believes the flywheel, the public capital, the new private funds, the massive global partnerships is finally spinning fast enough to return them to their historical 4 to 5% growth rate.
It really feels like they spent 2024 and 2025 painstakingly building this new machine, and 2026 is the year they finally turn it on to full power.
I think that is a very fair assessment. They have diversified their capital sources so thoroughly that they are no longer held hostage by the Federal Reserve's interest rate decisions or the daily mood of their own stock price.
So let's bring this all together for our listener who might be pretty skeptical about commercial real estate right now.
Yeah.
We started this deep dive by saying Realty Income isn't just a boring landlord anymore.
Right. They have truly evolved from a simple U.S. retail landlord into what I would confidently call a global real estate merchant bank.
A merchant bank is a very strong term to use for a REIT.
But it fits perfectly. They are sourcing massive amounts of capital from all over the world, pension funds, sovereigns, public markets. They are deploying it aggressively across borders, the U.S., Europe, and now Mexico. And they are offering highly complex financial solutions, things like build-to-suit development, preferred equity tranches, massive sale-leasebacks to gigantic clients like Blackstone.
And what is the ultimate takeaway for you, the investor listening to this?
The primary lesson here is that long-term stability requires constant evolution. If Realty Income had stubbornly just stayed a U.S. retail landlord, their margins would be shrinking right now. The math of the zero interest rate world just doesn't work anymore. The only reason that sacred monthly dividend is still safe is precisely because the company became vastly more complex. They embraced the complexity of private funds, data centers, gaming assets, and the Mexican industrial boom.
They literally had to change their entire DNA just to stay the same dependable stock people expect.
Perfectly put.
Now, before we wrap up, I want to leave you with one final thought, something to chew on as you look at your portfolio.
Sure, what is it?
Management mentioned on this call that they're sitting on $3 billion in total liquidity. They have built this proprietary tech platform built for massive scale. They are currently proving that the private fund model works in the U.S. They're testing the waters in Mexico with sovereign wealth. If this private fund model works as well as they think, and if the Mexico expansion is a hit, how long until we see a global Realty Income fund? How long until O isn't just viewed as a REIT, but is basically trading as a public version of Blackstone?
That is the multi-billion-dollar question right there. If they can replicate this private fund success in Europe or across completely different asset classes globally, the valuation multiple on this company changes completely. Wall Street will stop valuing them as a slow-growth landlord and start valuing them as a high-margin asset manager. And asset managers get much, much higher multiples.
A public Blackstone that pays you a reliable monthly dividend. Now, that is a truly interesting thought. We will definitely have to watch Q1 to see if this new machine keeps spinning. Thanks for unpacking all of this with us.
Always a pleasure.
See you next time on The Deep Dive.